Now, Bank Negara's surprise move is seen as a preemptive measure to curb rising prices. We speak to Carmelo Ferlito from Center for Market Education on the decision.
The decision of rising the interest rate doesn't produce an automatic cooling down of prices. It depends on how that decision is interpreted, both by consumers and investors. Furthermore, there is a time lag between the moment in which the decision is taken and the effects are produced. So it doesn't happen overnight, like nothing in the economic process. And finally, there is the risk, while we are at the beginning of the economic recovery post-COVID, that this will discourage investments and therefore bring along a recession.
The U.S. Central Bank had last week announced a 0.5% interest rate hike, its highest increase in more than 20 years. The move comes as a number of other countries cut lending rates to deal with rising prices. But how would rising borrowing costs impact growth and investments?
There are investors, domestically and internationally, that are at the doors of Malaysia or are already in the country thinking if they have to invest more to create more economic development. And they will decide so only if they expect strong and stable returns. We should not frustrate that expectations, creating a climate of uncertainty, creating bad policies. So if the general policy environment is business friendly, then the impact of a raise on the interest rate will be limited. Instead, if we are surrounded by a negative environment for profit expectations, then the raise of the interest rate will play harder on investment decisions.